TCS has finally got that 15,000 crore order from BSNL for 5G. Tejas network will benefit because that order in a sense will also benefit a company like Tejas. So TCS, for them, it's not like a game-changing move. For Tejas, this is going to be a big, big spark, so to speak. 670 for Tejas. Tejas is now a Tata Group company. That's why I'm bringing it out. You don't remember it? Yeah, it's a Tata Group company. Tata acquired it post-COVID, I think, at 220, 230. And from there, it's been a 3x. Finally, that order has come through. Let's see how the stock reacts today. In the pre-open session, where are the PSU banks? PSU banks, why? Because, the 2000 rupee note, 10% is under circulation. Now, typically, human habits are very easy to understand. If the money comes out of your closet, and if it goes back to the bank, which it has to, because post-September, 2000 rupee note will not be a legal tender, it means that the deposits for banks in the near term will increase. If 50% of the deposits stay back, which is what it does, because once you deposit the money, you're not going to withdraw it automatically, it is going to be shoring up some of the deposits and the CASA ratio for some of the banks. So I will not be surprised that in the near term, you could see a little bit of effect of that on the bond yields, and especially for some of the PSU banks. Bank of India, State Bank of India, the big ones actually would be beneficiary. Siemens, what have they done and why have they done? I don't know. I think the stock is going to be on the receiving end. There you go, 3% lower for Siemens. Zomato, direction is right, but the stock is up 20% from the recent low, which means that the result upside purely will be captured. So you may not see a big spark in Zomato based on these numbers, even though directly nothing wrong with the numbers. At least it will not fall post numbers. Delivery, why is there a loss? Everybody else in that same space is talking about profit. Here's a company which has come out and as the losses are bloated. 350 rupees, down 3% in the pre-open session. So it's going to be a news-heavy Monday morning. But Tejas Network, finally that order has kicked in. I think would be the big one from the mid-cap space. Kunal, let's understand the importance of this week's FNO expiry.
Well, I think it's significant because of two fronts. One is that this is the second straight month of bullish sentiment for the markets. I think from the month of April or March end, where there was extreme amount of negativity. So this is the second carry forward month. Very interestingly, the premiums for this month have been substantially low. So if you remember, I think December, January, February, March, these were 4 months where the premium on the index, say for example for the Nifty, was above 100 points, 110, 120 points on an average. Throughout this expiry, the premium had been in the range of 60, 70 for the Nifty. So that again is a very important phenomena, that whether the premium shoots up back towards 100 plus points and whether it remains at 100 plus points or not. So that will be another factor to watch out for. And the third and the most important is this month we've seen a lot of broader market participation and less of strong sector participation coming back. So whether we see a change of phenomena happening back again, where the move gets back into the larger cap sectors, the likes of the large cap private sector banking names, Reliance, etc., which is underperformed. So I think it's going to be a very crucial expiry in that regards.
All right, there you have it. It is going to be a crucial expiry, but let's find out what the index calls are as well. Then in light of that, as we step into expiry week, from our chartists, a consensus hold recommendation on the Nifty is the recommendation from both Kunal as well as Naresh, and that's exactly what the market moodometer reflects. Do remember, debt ceiling talks are dominating global market sentiment, and this morning on the pre-open rates, we've gotten off on the back foot. On the Nifty Bank, ditto then, that's the recommendation call coming in, a hold call on the Nifty Bank Index.
For the market open this Monday morning, just want to revisit what the SGX Nifty as well as the pre-open rates are settling in at, and absolutely flat once again. 18,200 is what the pre-open rate is indicating. Flat for the SGX Nifty as well. 18,235 is where we're currently at. A lot of stocks which are going to be in focus this morning. A lot of earnings reactions as well coming in. But prima facie, Kunal, you think that we're going to be range bound, a 100-point band for the Nifty is what you indicated?
Yeah, I think largely because at a options expiry level, there's been a huge activity in terms of quantum of writing for the large cap names, and the combo premium for call and put both is around 1% to 1.5% for, say, for the likes of HDFC Bank, Reliance, Dabur, HUL, etc. And that generally indicates that traders are positioned for this week expiry on the large cap names, that the large cap names would not fluctuate between 1 to 1.5% band. And because most of these large cap names have a heavy weightage on the indices, that also indicates that the Nifty would also remain in this band of 1% to 1.5%. So I think we would get back into the same range of the previous week, 18,050 as a support, 18,450 broadly as a resistance. Closer we are to the bands. So for example, if we come back towards 18,050 mark, it's actually a good contra zone to buy. And if we come back to 18,450 levels, 400 levels, that's actually a good zone to book out some profits and then wait out for the intraday dips.
Okay, getting set then for the market open this morning while we are in for a very, very quiet start, it seems. Just to put it into perspective as to how the markets have panned out in the week gone by, while it was all about the debt limit concerns, which by the way still persist on Wall Street. So it's been a little bit of an iffy handover from Wall Street as well on Friday night. Important to note that FIIs have actually turned net sellers after 16 sessions. Nothing to worry or get alarmed about because it's a minuscule of a sell figure coming in on Friday amidst all the news flow that was taking place. But yes, we've seen a bit of a dip or at least stall of that incoming flows that we had been seeing. We managed to snap the 3-day losing streak as well with Friday's price action, and the weekly decline has been the most one has seen since March 19th. Of course, what was also in focus on Friday, or rather over the weekend, I should say, is that the 2000 note cleanup has happened. While it will continue to be a legal tender up until September 30th, you have to go back to the banks and exchange it if you will. You got a lot of earnings coming in, Zomato as well as Delivery, top on our radar. We chatted with the management of Delivery, got you an analysis of Zomato's numbers as well. Delivery, of course, the net loss has come in at 158 odd crore rupees versus a loss of 119. So the loss is widened over there. There's good numbers coming in from JSW Steel, wherein the EBITDA per ton now stands at 11,000 rupees per ton. Bandhan Bank as well, wherein the FY29 loan growth guidance has come in at 20%, and they're targeting NIMs of about 7 to 7.5% for the fiscal. That's another stock to look out for. Good numbers coming in from Muthoot Finance, good numbers coming in from Divi's Labs as well, which has posted revenues which are above estimates. There's been a margin expansion as well on a year-on-year basis. So all these stocks then on our radar. The first rates on your screen, an absolutely flatter print there, 18,200 is where we're currently at for the Nifty. The broader market, a tad bit better, at least the first rates are indicating that there's more to the green on the NSE advances. Let's see what a Zomato is up to, what a Delivery is doing and how it's reacting to its earnings. Then we'll come out with a slew of good set of numbers. So I pointed out JSW Steel, Bandhan Bank, Muthoot Finance, Divi's, even NTPC. The EBITDA has risen about 3.7%. The profits have come in above estimates. There's BEL, which has managed to meet its revenue guidance. The margins have come in at 28.3%. Crompton Greaves as well, good set of numbers there. IRB Infra, wherein the EBITDA has jumped up about 18.3%. The margins have risen about 200 basis points. Wellspun Enterprises as well, there's an EBITDA uptick of about 25.5%. So good numbers coming in from this set. And then of course, there is Viatech Babag, which has come out with its numbers. There's Narayana Hridayalaya, which has come out with its numbers. And on the weak side, there's Glenmark, wherein the numbers actually have disappointed this time around. The net loss has come in at 428 crore rupees versus a profit on a year-on-year business. It's actually the India business which has actually taken a hit, 4.25% lower for Glenmark as we speak right now. Delivery, Sun TV, Abbott India, MCX, Cochin Shipyard, wherein the revenue has come in down by about 50.5%, although the management in their conference call indicated that looking at sequential performance is not the right way to judge the business of Cochin Shipyard, but that stock has gapped down 10%. I guess it's also got to do with the kind of fancy and frenzy which was going around for the entire defense pack and the kind of over-ownership that we had seen of late. Cochin Shipyard has gapped down 10.25% as we speak right now. There's also VRL Logistics, Balaji Amines, which have all come out with their numbers. And then also good set of numbers coming in from a Tourism Finance Corp, from a Neel Kamal, from a Dalmia Bharat. There's also Gati, wherein the losses have contracted in the fourth quarter. These are all good set of numbers. The Nifty then settles in absolutely quiet for itself. Just going to refresh my screens. Yep, absolutely flat at 18,216. Muthoot Finance is your big winner today, 4.5% higher. Adani Enterprises as well after that semi-clean chit that we got from the Supreme Court for the Adani group of names in the Hindenburg case. Adani Ports as well higher by 2%. Crompton, Dixon, these are all gainers. Siemens is gapped down 8%. MCX, Glenmark, all seeing earnings reactions. Kunal, your first take on trade and if there are any trades that you're punching in.
Yeah, I'm expecting the index to be absolutely flat, as we discussed earlier, both the Nifty as well as for the Bank Nifty. So I think it's a good time for option writers to try and write the index options. In terms of individual stocks, Ashok Leyland is something which looks attractive at 153 mark. The stock has been consistently showing signs of strength, and auto sector apparently has been one of the few sectors which have been a lot more resilient. So would pick up Ashok Leyland at current levels.
All right, that's Kunal's first trade. What about you, Naresh?
So that would be a buy on Infosys. That's a stock which is shaping up for a bounce back from here. The stock has done nothing for quite some time. So expecting a bounce from here towards 1320, 1340 levels.
Okay, time then for markets and more with none other than Sunil Singhania. So let me quickly toss it across to Nikunj. He's in conversation with him. Nikunj?
All right, hello and welcome to a brand new show of Market and Makers with Sunil Singhania. We got Sunil back at a time when some would say that we are at a crucial juncture. Worst is certainly behind us. The economy has rebalanced itself after the Ukraine crisis. Same time last year, there was extraordinary spike in inflation, but now globally things are looking settled. But markets will always get something to worry about. Last time when we spoke to Sunil, we were worried about oil, commodity prices. Now markets have started talking about the importance of electoral cycle and the outcome of state election and what will happen to the general election cycle in 2024. So all that and much more with Sunil Singhania in this edition of Markets and More. Sunil, it's been a good comeback by the bulls. The Nifty is up 1500 points plus from the recent low. For a market where 6 weeks ago everybody was talking about breakdown, now we have a breakout in front of us. What to your mind which has changed in the last 6 to 8 weeks which has made bulls make such a strong comeback?
Good morning, Nikunj. Thanks for having me back. So, I think one thing we have to remember is that earlier, we used to have a 15-20% move in the market once in 2-3 years. I think we are in a zone where we'll have a 15% move in the market 2-3 times a year. And I think that is the reason you are seeing this bouts of, markets going down and coming up from time to time. The world is very correlated. I think markets are taking a cue from each other, and therefore you are seeing this sharp moves up and down. On the other hand, I think you are right. The things seem to be stabilizing in the world. Our view on oil has always been of a softer oil, and we still continue to believe that oil will settle more like $60-65 than where it was. It's already down to 70. The world also has started to believe that inflation has seen its peak, and as a consequence of that, interest rate has also seen a peak. And on the other hand, you also have cost pressure which companies were facing because of raw material moves and freight moves and also energy costs. They are also stabilizing. And on the fourth side, you have China, which had a very strict COVID policy sort of reopening, and there is an optimism that there will be some growth there. So the world in 2023 second half should be much better than what it was in the last 1 year. And maybe that is a reflection which the markets are basically showing us. As far as India is concerned, result season has been pretty good. Obviously the very obvious sector, which was the financials, has done much more and much better than what was expected. And other sectors have performed in line or better than the muted expectations which the street generally had. And as we move forward, again, the optimism is that with interest rates coming off, so 10-year yields in India are down below 7%. Inflation has hit a significant low post the Russia-Ukraine issue even in India. and general optimism of good growth going forward. And the markets are looking with a lot of optimism. And the last thing is 18 months we have not seen Nifty go anywhere. So we are still at the October 21 levels as far as Nifty is concerned. And in this last 18 months, we have had 6 quarters where cumulative earnings has gone up by almost 25-30%. So the Nifty P multiple on a 1 year forward, which used to be like 24-25 times, is down to like 16-17 times. So overall valuations also seem to be much more reasonable than what they were maybe 18 months back.
You started your opening remarks with a 15 to 20% move. It could happen 2 or 3 times in a year. It's like saying that, you know, your birthday may come once in a year, but you will get these big moves at least 2 or 3 times in a year. So if I look at the recent rally, looks like in this recent rally, which is the summer of 2023 rally, it still has some more headroom left.
I frankly, you know, howsoever and how many times we might try, near-term moves are just a toss of a coin. And frankly, don't know. You know, geopolitical situation in the world keeps on giving you surprises and shocks from time to time. So don't know. But one thing is very sure that the appetite for Indian equity from domestic continues to be very strong. And from the global guys seem to be increasing, you know, quite visibly. And I think that should ensure that markets are not going to come down in a hurry. And if we are lucky and if we have a good monsoon backed by good growth, which is sort of becoming visible, the government's resolve on spending money on infrastructure, which again is very visible, and corporate India also looking at expansion, which is also visible. I think we have a good sort of a mix of both macro as well as you know, flows supporting the market.
Come back and I'm reading your note, the signing Shan random thoughts by Sunil Singhania. I mean, these are not random thoughts, these are very valuable inputs for everybody. You've come back from a long, if I may so, work holiday from New York to Omaha to taking an EV ride to spending time with your son Ujjwal.
Yeah, it was not a holiday, it was work. Obviously, when you're working during the day, evenings become holiday. But it was good, Nikunj, you know. I used to be traveling to US maybe once in 3-4 months earlier. During COVID, you had a long break, and the last time I went was October 22. But things were not very open that time. So I think this trip was very insightful. You know, you were able to meet people right from fund managers as well as allocators in New York. I met a lot of interesting people during the Warren Buffett, Charlie Munger's AGM in Omaha, and then in the Bay Valley actually saw the evolution of electric vehicles and the technology landscape in person. I think it's a big sort of a learning. So it was very insightful, and I think one thing which is very clear and which I mentioned in my note, that the move from dragon to elephant is very visible. You know, I think across the board, allocators as well as investors are looking at some move away from their allocation to China into other countries, and India is coming up quite, you know, I would say strongly up there. The other thing is obviously, you know, this move towards digital technology, electric vehicle is for real. It's not going to go away. So you might argue that stocks are cheap, expensive in the near term. They might go up and down, but structurally this move is for real.
So Sunil, if the India appeal is so strong and so you know, encouraging, then why is that for 2022 we had a big fat sell number by FIs? And if I look at this year also, even though last 10-15 days FIs are back, on a net basis the number is still down 29,000 crore for the year.
कभी होता नहीं है.
Is my voice reaching you? Hi, Sunil, is my voice reaching you? Looks like we've got you know, Sunil on a bad line. I'm just simply going through his notes, and the note is titled "The Singing Sun: Random Thoughts" by Sunil Singhania, and he's covered a range of topics in this. The move from dragon to elephant, the move that, you know, how EV is something which is real, and EV is something which will change the way how the transportation industry in the world would move. He's talking about a very simple things about takeaways from Berkshire Hathaway. Berkshire Hathaway is being successful in life is not doing too many extraordinary things but doing things consistently well. Love for one work is greater satisfaction than all the luxuries in the world. Okay, Sunil is back. Sunil, in your note, and you've just highlighted that the India appeal and the interest towards India is at an all-time high. If that is the underlying mood, then what explains that big fat sell number for 2022? And even for the year, FIs may be back, but the number is still down 29,000 crore on a YTD basis.
So obviously, Nikunj, last 1 year has been a very difficult year. You had the Russia-Ukraine war, oil went up to 140, all the commodities went up sharply. And obviously, India was relatively doing very, very well. And it's typical that when you have your view on the global equity markets not being positive, and there is one country which does well. So one is the overweight increases, and the other is you tend to knock off what is doing well. So I think that was one reason maybe. And second is, there is no one-on-one correlation on a day-to-day basis that, if they are positive, they will pump in like billions and billions of dollars immediately. It takes time. Obviously, India has always been an expensive country. It was very expensive maybe from their end last year. It is now at a reasonable level. And we are already seeing, this month we are almost seeing close to $800-900 million come into the country. So I don't know whether it will be near term or medium term, but we are very positive that over the next 18 months, we should get back what we sort of lost in terms of outflows over the last 18 months.
Sunil, can I say that right now we are going through the phase of the market that markets are at an all-time high, but the commitment levels perhaps are at a record low. FIs have been net sellers, HNI activity has been low, FNO open interest has been low. So it's like saying that market ऊपर गया है, मगर माल किसी के पास नहीं है. Nobody owns stocks.
I don't think that is true. Yes, you can say that the overweight on India from foreign investors is not as high as it used to be. And therefore, there is room for some reallocation there. And as I said, the world dynamics are changing. We call it the 4D, in favor of India. One is democracy. I think the world has realized the importance of democracy post what happened in Russia and maybe a threat of what might happen in China. The second is demographics. I think India is going to be a young country at least for the next 20 years with a median age of like 30 years or lower. Third is obviously the huge domestic demand. And we always say that in 22, when the world was debating whether they will have a recession or they will just about have a 0% growth. In India, the debate was whether we'll grow at 6% and 7%. And I think it's a great debate to have. And that was all largely because almost 80 to 83% of the Indian economy is domestic. And we have all seen how after 3-4 years post-COVID, we have started going on holidays, spending on festivals, weddings, and so on and so forth. And that is clearly visible in the strong domestic demand. And I think the fourth thing is the digital, benefit which the economy is getting. I think India has lagged in terms of physical infrastructure. We're trying to make up for that. But the digital infrastructure has been awesome. Tax collections are up 20% because compliance is higher. We have the UPIs and so many other things which have made India as an economy very efficient. And I think all this leads us to believe that if there is one economy, large economy in the world, which can continue to grow at 6-7% for the next 7, 8, 10 years, I think it is India. And if you grow that, the economy size almost doubles from 3 trillion to 6.5 trillion. And I think that is the kind of wealth which can be made. So it will happen. Obviously, as I said, India relatively turns out to be quite expensive. And therefore, investors take their time, before taking a call on whether to go all out or just start nibbling.
Sunil, since there is a very explicit mention of EV in your newsletter, let's understand that what is the best way an investor can really participate in the entire EV space?
No, in India, unfortunately, not too many direct plays. But, the biggest positive which I get from this is the fact that fossil fuel over a period of time is going to be weak. And I think from an India perspective, that is the biggest, good news that can happen. Already our services exports now are more than what we spend on oil imports. And I think that is the reason why balance of payment for India looks very, very healthy in 24. And again, that is one thing which is giving us a confidence that Indian rupee might be much more stable than other currencies in the world. So I think from an India perspective, whether you get opportunities to invest directly in EV plays or not, I don't know. But indirect benefit to the economy is going to be huge. And I think over a period of time, as the segment becomes bigger, we have already started seeing Teslas of the world looking at setting a base in India. And when that happens, I think even if no direct play, there will be a lot of indirect plays which will be available over a period of time. So it's still early days. There are a few auto companies who are trying to make their mark on the EV space. But I think over a period of time, we'll get an opportunity.
Sunil, you've been shopping a lot, and that's what the bulk deals are indicating, from Uniparts to Dynamatic Technologies, Mastech, Ion Exchange. In the small and the mid-cap space, are you following any kind of a theme, or these are company-specific investments irrespective of what the sector is doing?
So, we can talk about themes and all, but I think the biggest theme for us is as follows. We invest in companies which make profit, where there is visible profit growth, and what we pay today would be more than repaid back to us by way of future profitability. So I think across the board, across our names, I think these are the themes which you'll see in common. Obviously, there will be always some sectors which do well from time to time. I think companies which have done well for us are companies where there has been, good, I would say, respect as far as capital allocation is concerned, and where there is profit growth. And companies which have not done well are the ones where profit growth has faltered. So I think this is a very simple way of investing, but I think simplicity works.
What is your view on banks, given that right now there is a consensus view that banks is the way forward? Credit growth is strong, NPAs are down, this entire 2,000 rupee move by the government maybe could also help some of the banks in garnering deposits on the margin. Do you think banks is more like a consensus view and a consensus trade?
So obviously in any economy, in particular in a growing economy, financial services and banks will play a major role. I think when in Indian markets, banks and financial services are almost 35-40% of the economy as well as the markets. And so it is very natural for most investors to have a decent allocation to banks. I think having said that, there are a few things. One is, profit growth looks to be very strong next 2 years. Interest rate seems to have peaked, and at the margin, you might see interest rates coming down, and banks normally are inversely correlated to interest rate in terms of their price performance. Third, I think the practices of banks have improved quite dramatically. So the incidence of NPAs or credit cost should be much lower than earlier. And there is huge regulatory protection. You just can't set up a bank overnight. There is a regulatory protection to existing players, and therefore there is this moat. Having said that, I think this near-term moves of 2000 note and all, I don't think there is any merit in becoming positive or negative because of that. But structurally for the next 3-4 years, if the economy, as I said, is to grow from 3 trillion to 6-7 trillion, I think financial services will play a major role and will continue to be quite constructive on the bank. The only thing is bank on names where there is good brand name, because from a banking perspective, deposits as well as cost of deposits is the raw material. And the better you are there, the more competitive you become.
Sunil, you bought very differentiated IT names in the past, and one classic call has been, let's say, Root Mobile, which has run rather well for you. Now I can see there is ICICI Securities, which is a blend on both financial services and technology. Since everybody knows that the nature of the economy is moving more towards digital, what is the best way to participate in it?
I think every business, irrespective of which business you are in, will have to have a digital strategy. So I think more than what is the best way to participate, Nikunj, one has to be very clear that stay away from companies which will not adapt themselves to embracing this truth. You mentioned about EVs. I think EVs, even if there are no direct plays, at least avoid companies which will get impacted because of the EV play. I think similar is the case with digital. Having said that, obviously there are quite a few good names which got listed, and hats off to them for creating businesses out of nowhere, hiring hundreds and thousands and lakhs of people in India. but a lot of them don't fall into our criteria of being profit making and having decent return on capital employed. And therefore we tend to avoid, we don't understand those businesses. But I'm very sure that there are other smarter fund managers who would understand those businesses. So I think from an investor's perspective, depending on their risk appetite and depending on their philosophy, there are quite a few names available where they can definitely look at investing.
Is it a good time to revisit large cap IT, the classic? Buy them at the time of downturn, sell them at the time of upturn. Is the downturn enough? Are valuations attractive enough to go back to large cap IT?
No, it sometimes, when you listen to the technology experts, it is a little scary, particularly for financial people like me at least. When they talk about this chat GPT and AI and all taking away jobs. But then I'm reminded right from the last 50 years, starting from the movie Naya Daur, where in a village the tangewalas get threatened by the motor bus which comes in. To the computerization which happened and Indian bank employees went on strike, to even Y2K and post Y2K and so on and so forth. I think Indian IT services is one sector which is globally competitive. We discussed that every company needs to have a digital strategy, and there is going to be huge opportunity for Indian IT services companies there. Yes, in the near term, we don't know. It is possible that 1 or 2 quarters, the growth rates might be not as good as they used to be earlier. But these are companies which make decent money. As I said, they are globally competitive, and they have almost 100% cash conversion of profit, and they distribute almost 80-90% of that. In fact, if you actually see year to date, there are so many IT services companies which have gone up like 30-40% on the mid-cap side. And even in large caps, there are quite a few IT services companies which have done much better than the Nifty. So despite all these concerns and slowdown and so on and so forth, I think the sector has done relatively well year to date. Yes, on a one-year basis, it has underperformed because the previous 1 year it had done very, very well. But, the prices are not indicating, I would say, a horror show. In fact, they are indicating that if things settle down, there might be an upside surprise here. So we are not extraordinarily overweight, but we are not underweight also.
Sunil Singhania there giving us his overall view on the markets. He doesn't think that the markets will come down in a hurry and that the appetite for equities remains strong. EV is an emerging theme, lots of opportunities there. Financial services, banks will continue to play a major role, and he continues to reiterate that one should stick to large quality names in banks, and that and one needs to have a decent allocation to the entire financials space. All right, let's move right on then and bring on board Jayant Acharya. He's the Deputy Managing Director at JSW Steel, joining in to discuss their quarterly performance as well as the recent fundraise via the NCD route. Mr. Acharya, thank you for taking time out. You've delivered an impressive performance in Q4, a strong operational beat. What has aided this growth, and what is your outlook for FY24?
Our Q4 numbers have been good. It has been aided by a volume growth. We had a good volume growth in our Indian operations and in our overseas operations as well. The steel price cycle was in favor, and the steel prices had gone up in the Q4. And we had the advantage of lower cost raw material, especially coking coal, flowing in from the Q3 to Q4. So therefore, a higher volume growth, a lower cost structure, a better improved steel price. And we also had all the Indian subsidiaries and the overseas subsidiaries doing well. So by and large, this was very supportive. The volume growth was primarily driven, I would say, first India, by good demand growth. We saw a 13% increase in the Indian steel demand last year, aided by a strong government capex. We now see private capex coming in as well. We see good manufacturing activity picking up. Energy transition into renewables is also consuming a lot of steel. And we see the service component also doing quite well, which is aiding the consumption demand. And all in all, India is a very positive story. In our US operations also, we have done quite well. Ohio did very well in terms of overall operational parameters as well as volume. Baytown did very strong performance on volumes as well as EBITDA. And our Italian operations did quite well on a back of a railway orders from the Italian government. And we have a visibility of railway orders for better part of this year as well.
Right. You mentioned about 13% volume growth rate in India, but if I look at your FY24 volume guidance, it translates to single-digit growth in FY24. Why is that?
So just to clarify what I mentioned, the Indian demand grew by 13%. Our Indian domestic sales, if you were to look at, grew by 15% on our Indian operations basis, and slightly better than what India has done. And if you were to look at the overall year, India grew by 13% again. And at JSW Steel Indian operations, we have grown sales by 24%. So we have done better from that perspective versus what India has done. The export numbers have been lower, primarily because of the export duty, which was levied till November. It was taken off in November, and therefore we see exports rising from the last quarter onwards. So that's an additional window of opportunity which has opened up, and we do see that exports now will aid the overall volume story going ahead.
No, I just want to reframe that. I want to understand if whether or not you're expecting a double-digit volume growth in India for FY24.
I would say that we expect, if you were to look at the year FY24, first let me talk about India. We are expecting India to grow in the region of 8%, which would mean it would add about 10 million tons with respect to the overall demand. As far as our growth in the next year is concerned for the Indian steel industry, we expect to grow maybe in a range of between 8 to 10%. Our capacity utilization, if you were to look at last quarter, was 96%. It was 90% for the year as a whole. So we are basically utilizing our full capacities which are available. And we would be continuing to do that. Our additional capacities in this year would play out in terms of volume from the Dolvi ramp-up, which is taking place, the BPSL ramp-up, which is happening, and additional capacities which are coming up both at Vijayanagar and in BPSL, which would be more back-ended for the year.
Right. You mentioned in your first answer that you see a lot of tailwinds with regards to margins. So walk us through what EBITDA per ton could look like for the full fiscal.
Going forward into quarter one, we see that while there is a softening in international steel prices because of primarily a subdued demand in China post-opening, however, we see that the Chinese government has announced certain measures to contain the overall manufacturing to similar to calendar 22, which would mean that in the remaining months of this year, the Chinese production would get moderated by about 6 to 7 million tons per month, which is basically going to aid the global sentiments and also the global steel prices. Having said that, I think even if there is a softening of prices, which we have seen in the month of May as well as in India, our prices softened by about $25 odd. We see that the raw material prices which have gone down, let's say coking coal has gone, if you were to look at on an average by $90 to $100 from quarter four average to going into the current level as we see today. This advantage will start flowing into our business from June, July onwards. So we see that the margins to that extent remains range bound and I would say reasonably healthy going into the next 2 quarters.
And you had mentioned that capacity addition is going to be a lever for growth. So is it fair to assume the 37 million tons per annum capacity target is now on track?
Yeah, so our capex, our expansions to 37 million tons in India is on track. And our capex last year, we have spent about 14,200 crores on our capex. This year as well, we have budgeted to spend about 19,000 crores plus on our capex expansions, which is for growth cost-saving projects, and backward integration on our mining assets. So some of the mines which we have won recently, as well as the ongoing mining operations to stabilize and improve various sustainable mining operations in both Orissa and Karnataka.
Right. You also announced some fundraise along with your earnings, possibly to fund the capex that you talked about. In light of that, what would be the net debt, say, by the end of the financial year?
So as you have seen, our net debt has reduced by about 10,000 crores by 31st March of 23. And we expect that the debt will remain range bound. The only addition which we expect, likely addition which we expect, is from the merger of JISPL when that happens, which would add a debt of about 3,000 crores approximately. So in spite of the fact that we have undertaken a very large capex program and are ready for the growth phase in India, our debt would remain range bound, barring this addition of JISPL debt.
Right. And given the low base of exports, do you expect the share of exports to actually jump up marginally in the fiscal?
So the last quarter we had an export percentage of 15%, and I think going forward we have been in this range of 15 to 20% exports, and the balance 80 to 85% in the domestic. Going forward, I think we would see, because India underplay is strong, our focus will remain the domestic market, and we would see export in the range of this 15% to 20% if the opportunity is very good, continuing going forward.
Right. Lastly, Mr. Acharya, the value-added products share. You said that it's likely to hit 55 to 60 odd percent, or rather that is what the market assumption is. Is that a fair assumption?
Correct. The value-added product and special products would be in the range of 55 to 60%.
Okay, Mr. Acharya, great to have you today on ET Now. Thanks as always for taking the time out. Good speaking with you. Let's just take a very quick break with news that after a quiet start, we've actually picked up in the green. We are 77 points higher, 18,300 back on the ticker.
Good to have you back with us, quoting comfortably in the green, actually much unlike what the global markets had thrown up, as well as what the pre-open rates were indicating. And in fact, we're perched at the highest point of the trading day now at 18,292. Balaji Amines Siemens continues to reel under pressure after Friday's drubbing, another knock of nearly 10% on the back of the sale of their motors business. And you've also got Ashoka Buildcon that's under pressure. But let's connect with Chandrasekhar Ghosh, who's the Managing Director and CEO at Bandhan Bank, who is joining in on the show to talk numbers. Good to have you on board now. The net interest margin improvement has been expected. So what is the outlook on margins going into FY24?
We see that the marginally it has been improved NIM, which is the good for this quarter. And I feel that the next financial year, this means the 23-24 will continue the same level, which is a 7% to 7.5% will be continue.
Right. And where will margins normalize as your portfolio evolves, say FY25 onwards?
No, mixed, we are feeling that will be like to making it as a policy of the bank for diversification. So I feel that the 2026 will be like to settle that the mixed.
Now, given that growth has returned, will that be the big change for you in FY24? Can you walk us through your guidance?
We see that whatever the growth has come to the last quarter, for the last financial year, it has been given the very good confidence, the credit growth has come back. So that the 23-24, I feel that the credit growth will become more than 20%.
Right. Tell us about your credit costs as well, and if FY24 would be a year where credit costs are going to be steady, what is your target then?
If you see that the last quarter, our credit cost has come down from 6.5 to 2.9, and it has been, if you see that the whole year it is a 4.43. So, we are expected as per trend of the collection efficiency, we find out, we feel that the 23-24 credit cost will become around 2%. And the steady basis, I feel that the 2025, it will become less than 2%, and 1.5 to 1.7% will be like to steady.
Deposit growth has been strong. Is it going to be key for you as the growth comes back?
If we see that the last financial year environmentally of the deposit is not very good, but within that situation, quarter on quarter basis, more than 6% deposit growth has come to the bank, and also 6% is the CASA deposit has come to the bank, and current account deposit has come to quarter on quarter 35%, which shows that the deposit growth is coming good way to the bank and customer confidence with Bandhan Bank. So, that the 23-24 will be feel that they are good deposit is coming one side. Second side on that, we are planned on that in the last year 520 branch will open, but we are couple of branch already opened in that last year, and 200 branch is pending. It will be open in this the first half of this financial year. That also given that the deposit of the bank. Third point, we have that the large amount of 50% of the branch in a rural, and we are restructured our management system, so that the different channel have been developed only for rural, looking from the central office and drive to this local rural business more. That have been helped us on that to deposit growth will be steady and go fast on that.
So, will deposit growth be faster than credit growth?
Yes, it is correct.
Right. Your OPEX also has inched up and cost to income is now above 42%. What is it that you're investing in, and should we continue to expect elevated operating expenses?
If you see that there is a two bigger cost you are incurred on that. One cost is coming on that the new branch open, new business vertical have been developed, so that a lot of HR cost has come in there, and when they are coming to the full productivity, so automatically it will be given that the cost will be come down. And second cost is coming from my IT transformation, which I started from the last year, so that it is will also given little bit also cost is there. So, this financial year, that means 23-24 will become to little cost, and after that 23-24 it will become again the normal, which is the less than 40% of my cost to income ratio.
How are recoveries for you? How should one look at recoveries going forward, especially in FY24?
If you see that the customer is returning back, so we see that if it is a major of my portfolio is coming from the microcredit, and the microcredit customers, if I see that the last quarter disbursement happened 21,000 crores, that means they are coming back to the normal. It has been shows that the my credit cost will come down, and also my the delinquency has come down. Delinquency, if you see that another part, the 98.5% my collection efficiency has come. It has been also given a very good forecast. Third point, whatever I disbursed the loan 21, 22, 22, 23, all of the customers are paying me on time basis, which is more than 97%. And whatever I loan disbursed 22, 23, all of these customers are paying me on time basis 99% plus. So, these are the couple of indicators showing that my risk is not moving up, it is going to further coming down on that, and that is the good financial year is coming 23, 24 and onwards.
Right, and you plan to diversify your book. Can you tell us what the outlook is for the book beyond FY24? Will diversification be achieved through new customers or existing?
Now, if you see that the majorly my have that the three of books are growing. One is in microcredit, second is my commercial banking, and third is my housing. So these are three, both all are the very focusing of the bank. So if I see that the my retail other than housing, it has been grown 232% year on year basis. If I say that my commercial banking, it has been grown in last year, which is 72% year on year. So in that sense, I feel that housing has come 13%. So housing will be grow to the 20 to 25%, and if it is a continue on the same 50% growth of the my commercial banking, the automatically it will be like to balance, which microcredit growth has come 8% in the last quarter. So balancing and mixing on that would coming as a very good on that.
Right. So where should one see your ROAs for FY24 as well as 25?
So I feel that the ROA will become to 2.6 to 2.8 in 2024. That I 23-24, I feel that, and the after the 24 it will become to the 3.
Appreciate your time. That's the management of Bandhan Bank giving us the latest details that it has been a tough year for FY23 when it comes to deposits, but down the line, risk is coming down, and they're talking about how growth in Q4 has given confidence on the overall outlook for credit growth. 239, that's where Bandhan Bank is currently at. Let's move right on then and connect with the management of STL, talking about their profits growing as well as what the outlook is when it comes to their EBITDA margin in the long haul. Sterlite Technologies is here, and we've got Ankit Agarwal, the managing director, with us. Thank you so much for taking time out. Now, let's just start off with your outlook on revenue growth guidance, because that has come in at about 10 to 12% in FY24, which is lower than the FY23 growth rate. Why have you lowered your revenue guidance?
Yes, good morning. Thank you for having me. So as we shared through the course of last 12 months, we focused a lot in terms of focusing on our core growth areas and the optical business in particular. We've also looked at focusing on services area in very specific markets, and particularly in the private sector. And we recently shared some more details about our foray into the IT services part. So when you look at where we are, I think there's a lot of focus that's come in the last 12 months, and we're quite proud of the way the business has grown. And broadly over the last 12 months, we grew, taking our business now to about 6,900 crores as we ended FY23. And as we currently see our market, we do see a good growth, particularly into the second half of this year. And overall for the year, we've guided between 10 to 12%. I think the key thing to understand here is that as the markets continue to grow for us, a big focus for us is particularly North America and Europe. And as we see both those markets, we believe there will be some concerns, particularly in North America. And we certainly believe that will ease out into H2, and where we will have better growth.
So just wanted to understand, approximately 5G, as we understand, has already been rolled out in about 3,500 towns and cities of the 7,000 present currently in the country. How many more orders and what kind of value of orders have you received so far? And, you're looking at rolling out in the future?
Sure. So one, I'll say from a global perspective, we have close to 1 billion subscribers for 5G. And what we believe broadly from a market perspective, this will take it to about 3.5, 4 billion subscribers in the next 4 to 5 years. So clearly there is tremendous network that needs to get built out for the next 4 to 5 years. On top of that, we're also seeing in India, for example, that we currently have anywhere between 50 to 70 million 5G subscribers. And that will get to about 250, 300 million subscribers in the next 3 years. So I think both of these are quite positive trends. There's significant amount of fiber infrastructure that is getting built out and has got accelerated. not only by Jio and Airtel, but we're also now seeing government looking to move forward with BharatNet on phase 3. And that will also require north of $10 billion of investment to make sure that fiber gets connected to 3 lakh plus villages, which are not connected currently. So when we look at a global scenario, there's a lot of fiber that needs to be done, both for 5G as well as fiber to the home, as well as in India for fiber to the home, fiber to enterprise, as well as for 5G connectivity.
Growth is lower than last year, but your fund requirement is higher. You've approved a right issue of 500 crore. You're looking at 1,000 crore, capital infusion. Why is that?
So I think overall, what we wanted to share is that clearly there is a vision for the optical business to become world top 3. That's something that we're very passionate about. We're very excited about. I think from where we are, 2-3 things are happening. Number one, we're taking our fiber cable capacity from 33 million to 42 million fiber kilometers. That capacity will largely come on stream by H1 of this year. So that's something that will add a good opportunity both on our top line and bottom line. The second part is we're looking to scale up our optical interconnect business. So there will be some investments that we look to scale that up. So these are largely the areas that we think currently where we need to make investments. Broadly, we're looking at investment about 350 to 400 crores to make both of these happen in the current year.
Growth really come back. For a business which is on the cusp of 5G, internationally things are looking up. 10 to 11% growth is growth, but that is not the growth which would excite anybody. I'm looking at when this 20% late teen growth, when will that come back?
So I think, look, broadly, as I said, over the next 3 years, 4 years, there is certainly a lot of opportunity for us to scale up. We ourselves are excited because we think we're in the right place, right time. There was a lot of focus in the last 12 months to deprioritize and defocus from other areas. We got into wireless, we were in OSS, BSS, we were in data center in the UK. So we've exited all of those. And so I think it's much more simplified business, but very focused business, as I said, particularly on the optical part. And we've also now announced in the last results a demerger of our services business, which will be very important for both businesses, this optical business and services business, to pursue their own growth journey. So I think with all of these actions in place, I think we're quite well placed for scaling up, as you're mentioning, with the tailwinds that are there on the market. What we've simply guided is that in H1, currently we do see some inventory build up in North America, because of which, as that clears through in H1 of our year, in H2, we believe there'll be stronger growth.
One question in the market also right now is, Ankit, that where were up until now annual cash flows deployed, given that debt hasn't quite come off substantially? And I mean, should we see any material reduction in the debt amount in this fiscal?
Yes, absolutely. And again, that's an important area for us. On one side, we do believe that we have this amount of capex, about 350, 400 CR. But that will then take us to the 42 million that we see is sufficient for our current growth and for the near-term growth. On the other side, we have talked about our debt coming down. So happy to share that our net debt did come down broadly from about 3,400 to around 3,100 net debt. And where we're looking to take this to by the end of the year is to take it to 2.5 times net debt EBITDA. So we think that is a healthy place for us to be. We do believe we will generate positive cash flows this year and take that partly to finance the capex and partly to reduce our debt.
Would you be participating in the right issue? I mean, would you be committing personal capital?
So from overall perspective, we have already shared the quantum is 500 crores. And the promoter would be participating. We're just looking at the market conditions, looking at the timing of it. And of course, based on board approval, etc., for the timing, we'll move forward.
The joker in the pack this year for everybody has been China. And I'm getting a conflicting signal. I speak to metal companies. Beginning of the year, they were worried. Now they are not worried. I speak to chemical companies. They continue to remain worried. China is the swing factor in your business. How is that moving this year?
So I think that's a change. I would like to highlight that we've very consciously chosen, if you look at where our sales today is, we're majority in US, in Europe, and then to a smaller extent in India, Australia, etc. So we very consciously shifted our focus markets to very large key accounts in these markets. And with them, we have secured typically 2 to 3 year contracts. So that's something that we're very positive about. It's been a lot of effort to build the right product portfolio of technology and IP to move towards absolute tier one customers. And to add to that, we've also made investments in these geographies from manufacturing perspective to make sure that we are the preferred partner for our customers. China is 50% of the world fiber market, but largely it largely matters how much the local demand is and how much the local players are able to keep up to that. So there has been some short-term delay in China mobile tender. In fact, in last few days, China telecom tender also came out, which was 16% higher. So I think overall we are positive about the China demand. They themselves are very bullish on 5G and already made some announcements linked to 6G. So again, from a next 5 to 7 year perspective, I continue to believe China will be strong in terms of fiber demand.
All right. Thanks so much then for taking time out and joining in and giving us a view as to how business is shaping up, Ankit. Good to have you on board. On that note then, just a quick glance at what the market is up to at 18,245. We clearly seem to be moving from strength to strength, but it's the frontliners that seem to be doing all the heavy lifting. Just want to highlight some of the names as well that are contributing on the upside. And you've got names like Adani Enterprises, Divi's Labs, Bajaj Auto, Sun Pharma, Dr. Reddy's, as well as Cipla holding out. Not to mention Reliance Industries up 0.5%. Quick break, come right back for lots more.